Mark, let's have a conversation then more broadly about these markets in 3 minutes. And I want to go back to one of our headlines, and that is the Chinese data. Over the weekend, we got these really poor PMI numbers coming through from China, underlining the lack of resilience, I suppose, in the rebound that some had got excited about. If this was a surprise to economists, was it not a surprise to markets? I mean, it doesn't seem to have wobbled the Asia session all that much.
It is like worrying how bad this data was, but I don't think this is the big surprise. I think the reason markets are a little bit more surprised overall in the China narrative in the past month, and I'm in this camp as well, is the fact that the policy support hasn't been as forthcoming as was promised and as we expected. So again, going back to the Chinese equities are never really a domestic growth play. They are very much a policy play, a liquidity play, and I think I was in the camp of expecting that the Chinese government would work to support Chinese stocks to get a little win ahead of the National People's Congress later on this year, and then it didn't really matter what happened around COVID and growth. What's happened is the growth story has been as negative as many of us has feared, and I've been kind of more pessimistic than most in that camp, and that's kind of come through, but we haven't got the positive policy. And I'm worried about that because the other dynamic is, of course, the property sector troubles are really spreading to the bank sector. This has been many years in the banking. We've been really wondering when this would really come to a head, and it seems that it's coming to a head for the Chinese government at the worst possible time, when you've got a terrible global macro environment. And that's why I still kind of retain my view that Chinese stocks can outperform throughout this year, but I have it with less conviction than I had earlier on this year.
Right. Yeah, and a lot from what you said then, a lot might depend on the policy response we see from Chinese authorities into the fall, into the autumn. Let me ask you then about your other big concern of the morning, which is around the Fed and where that narrative takes us then, Mark. And you mentioned that we might get some further pushback from Fed officials this week, and we seem to have had a little bit of that already, if that's what we got from Kashkari, reiterating that the Fed is committed, of course, to fighting inflation, and saying, I'm surprised by markets' interpretation of the Fed meeting. Is that telling us that the Fed thinks the July rally is a misstep?
Well, I'm pretty sure, I should have probably checked this before I came on the show, but I'm pretty sure Kashkari is not a voting member this year. And I think that some of the pushback we've seen so far has been from people who aren't voting members. So I think that's why the market hasn't taken too much into account. But also, partially, this move in yields is about momentum traders flipping their positions, going the other way. And we've seen some big technical breaks. And that's why I think the bond rally can continue a little bit further. Now, I've been in the camp that we would get a summer relief rally in equities and bonds, but it wouldn't be a long-term turning point. And I thought that might be the theme for August. However, I'm going to spend all of August permanently worried about when we do go back to the underlying trend of 22, which will have reasserted itself, and that is much higher yields and a much tougher environment for equities. And maybe we'll go back to that as soon as this week, because we do have Fed speakers on tap, we do have jobs data, and the data came through on Friday was very, very strong from the US, and we also see the ECI, the employment contract index, I think I've forgotten exactly the wording, the acronym, showed that was strong. The costs are expensive for labour in the US, and yields need to be higher later this year.